Right, welcome to this second session that I've done about what I call a crash course. Right, as you know, that the very first one we did was the introduction and then the reasons for not being successful. And I got some feedback on that one. A lot of people emailed me and said that that is exactly what they experienced while they were busy trading, learning to trade, demo trade, paper trade, whatever you want to call it. A lot of emotions and all those stuff that I talked about in that first lesson or first session was what people have experienced. I even had some emails that really won't say it made me sad in a sense, but also it really shook me in the sense that trading for some people has really become sort of a drug, and it really they got involved in a way that is sometimes I would say close to gambling, in that sense of the spirit that they really done it in. So what I want to do with this specific one is to really give the reasons for being successful. Now, first of all, point number one is to experience that the odds is in your favor. Now, that comes through a tested strategy. First of all, you won't know whether the odds is in your favor if you haven't got a strategy that you've tested, whether demo tested it. And then the second point is it comes through live trading. So you're only going to know that the odds is in your favor if you've tested a strategy and you've done some live trading with it. That's very important. Then the second point is, then that is a very important one, and that is if you have overcome the emotional leap from paper trading to live trading. Now that is an enormous step. A lot of people emailed me in the sense that they've gone from paper trading to live trading, and then it's a total different scenario. Emotions are different, and that emotional difference make that your decision making is also different. It distracts you away from what you've done while paper trading. So, point number one says it should be a small leap at first when going from paper to live trading in terms of money put at risk. Now, what I found is that people start demo trading with one mini lot, and the moment they go live trading, they go with one full lot. Think, right, now I can do it, and then eventually they end up losing. Right, point number two, it says you are not a successful trader yet, only a small step in that direction. You must remember, when successful in paper trading doesn't say that you're going to be successful in live trading. Your chances to be successful is the odds are way in your favor if you handle it right. Point number three, that's the most important part. It says the emotional leap are enormous. So keep the risk as low as possible to combat that. Right in the beginning, if you've paper traded with one lot, you should go in with not more than 20 to 25% of that at first. So that means a quarter of the risk that you've done with paper trading. And it's no use doing paper trading with one full lot if eventually when you start trading live, you only got enough capital to start with a mini lot, because that's also skewing the whole process. The main thing what I want to say here is to take your risk and make it a quarter of what you normally does. I know a lot of people, their accounts doesn't allow for parts of a mini lot, so that makes it difficult. And then you must know that you're gonna run into trouble if you cannot reduce your position size and your risk when going from paper trading to live trading. You have to do it. Right, then point number C, a very important one. It says there a monkey can enter a trade according to rules. but money is made by exiting it, by having an exit strategy. To have point number 1 says to have a tested exit strategy. Point number 2 says while a trade is open, no money is in the bank yet. It's no use having a trade open that says, yes, I'm 80 pips in the profit. And then at the end of the day, all those pips are given away and then you run into a loss. I spoke to a guy the other night that at one stage was trading 15 lots, full lots at a time. And eventually, that also got less and less and less. So what I'm trying to say is, when you have a solid strategy, you've got to have an exit strategy. And the exit strategy is not always according to certain rules. The rules say Fibonacci 161% extension, for instance. And now you start trading according to that. But when you get to that specific point, where the price starts losing momentum, it hasn't reached the 161% extension yet. So what are you going to do then? That is what is very important. How are you going to manage it? When there's candles telling you that the possibility are there, the facts are in front of you, that the possibility are there that this thing is busy turning around, and you've got 25 pips on the table, what do? That's what it's all about. But we have this mindset that we're going to make 100, 200 pips at a time, when I'm in the market. It doesn't work that way. Right. So you've got to have some exiting strategy in terms of candles, either by percentage turnaround from when it starts losing momentum. If you've got 30 pips at that stage, you must decide, right, I'm going to take 10 off the table, I'm going to allow it. So that's the type of decisions you have to take before the time. And while the market is running, you cannot actually make it before the time, decide on the pips, but you can decide, right, in this trade, that's more or less the target, but if it's not going to get there, that's where I will close the trade. And if it gets there, you close it. That's it. And then, point number D, consistency is the key. Point number 1 there is, do the same thing over and over again until it gets boring. That's what your trading should be. Point number 2, when the same action are taken under the same conditions. That's very important. I found people that I said, right, but there was a morning star and you're in a short position. Why didn't you either scale out or go to break even when that morning star arises at the bottom? And they said, yeah, but I thought. Or you might be in a long position and there's a bearish engulfing candle. And sometimes they close it and sometimes they don't. So it's by taking the same actions under the same conditions. That's very important. If your profit comes constantly, then the position size can be increased, but still within a risk tolerance. Now, when you start with consistently making pips, you can start increasing your position size, because remember, you start with a very small portion when you go from paper to live trading. So then as your consistency grows, you can add up till you get to your risk tolerance that you've set for yourself. Right, a healthy balance between risk and reward, that makes you successful. It should be more than 1-to-1 in the planning of the trade. That's not to say that it's always going to work out more than 1-to-1. Because sometimes you go into the trade, there's bad news and the turnaround before you get to that specific 1-to-1 ratio. Then you close it. But in your planning, your trade, it should be more than 1-to-1. Point number 2 says it might be cut short due to circumstances. Point 3, the risk side might also be cut short if there is a change. So your risk as well can be cut short. Because if there's bad news and you know you went long and it's going to influence the trade to go to the short side, sorry, and in the moment it is evident that it's going to go that way, you close the trade. You don't hope it's your stop is gonna hold, because say out of 100 trades you got 40 wrong and 60 right. Out of that 40, if you can only manage 25% of that, score a couple of pips there, it will enhance your reward side. Right, point number F, started small but is growing bigger. A lot of people that are successful started small. They let compound do the work for them. Point number 2, you just do the trading. So they started small and they grow with the risk as well. So even if they start trading big now, it's because they grew up to that specific point. And then point number G, trading according to a tested recipe. You got to have a tested recipe, and that's where your strategy, your backtesting comes in. You have to trade according to a tested plan, point number 1. Point number 2, the results should acknowledge the success of the plan. Your results should show that your plan is successful. Point number 3, the problem is that strategies do not make a good trader. There's more to trading than just have a strategy. Because if a strategy makes the money, then everybody should make money. And why doesn't it work like that? Because, point number 4, only time, knowledge, experience and guidance can make you the trader you want to be. Unfortunately, one of the bad things about not being successful, the feedback that I got is the time that people have to trade. They think they can do it with 10 or 20 minutes a day. It doesn't work like that. Eventually it might become like that. But at the beginning, it takes hard work, it takes study, it is becoming, you've got to become, get some knowledge, and then gain experience and guidance. That's very important. And then point number 8 says, the big mistakes are illuminated. That's very important. People that are successful doesn't make big mistakes anymore. The big mistakes come from, let's hope this thing recovers. Let's give it another chance. Let's lower or take my stop loss another 20 pips away. They don't make those mistakes anymore. Right, there are 2 types of mistakes. Point number 1 is the small ones and the big ones. Yes, you'll definitely make small mistakes along the way. Big mistakes, according to me, are not pulling the trigger when your strategy gives a signal. That's a big mistake. And I know a lot of people suffer with that because of losses that they endured. And that's why I say make your risk smaller, so that you will have ease of mind to pull the trigger. And then another one is not closing a trade when the rules tells you so. When you have set a stop loss strategy at a specific position, you have to close it. And then point number 3, study it all and then not trading. A lot of people is doing all the work, all the demo, they read what they can, and eventually they give up by not trading. They don't go live. They don't really go into it. So you got to decide after a certain time, demo trading, studying, you got to decide, is this for me, yes or no? Will I be able to do it? Does it fit my personality? And a lot of people that's been successful is they do it because they like it. It's not because just for making money. That's part of it, yes. And then the next one, I is risk are controlled. Let me just get there again. Risk are controlled as far as possible. Now, what does risk mean? To me, risk mean, sorry for that one, risk means not having control. Then point number 2, because you don't have control over risk, it means you can have controlling measures to handle the risk. Let me just move that up a little bit more. Right, there it is. Right, then it says there that the same principles apply in trading. You should have a formal education and prove your skills before you start to trade. Unfortunately, there are no tests required before you can open a brokerage account, but you should take the time to learn about the markets and develop a strategy before you hit the open road. When trading, you can also apply certain security features. Two of the most important are having a trading strategy and using stop losses. When you're new to trading, you should paper trade first. Then after you've built up some confidence, you can start trading with one lot per contract or 100 shares. I got this from, let me just quickly see where I got it from. It was taken from the complete guide to day trading, right? So it says there of that one of 100 shares, if you're comfortable and you achieve acceptable results, then you can increase the contract or share size. Just what I said on the previous points there. And then that second last one, don't trade to get rich quick. You can read through there. That's just a lesson from the complete guide to day trading. That means risk are controlled. It's not that risk, there's no risk. You've got some security measures in place to handle that. Right, then point number J, a balanced lifestyle is maintained. I just want to scroll down that a little bit. There it is. A balanced lifestyle is maintained. Right, then don't let your trading ruin your relationships with others, and don't let it become a drug. Now, that's very important. You got to have a balanced lifestyle. You got to set yourself boundaries in terms of times that you trade, how many minutes, hours per day, that only you will know that. And you got to sort that out as a household itself. This is one of the biggest problems that I've received from people say that it creates problem in the house between the husband and the wife, and if the wife are trading, between the wife and the husband, because of the time issue. You got to set yourself boundaries in terms of time and trade only within that time frame. Right now, I know with a 4 hour, if you go into a trade, what happens is after that you wanna look at it, you wanna manage it, and you sit there for 2-3 hours. So I know that is also difficult, but try to keep a balanced time frame for you, so that your lifestyle and your family life is not ruined by that. Right, and then point number K, it says there that emotions is controlled by a predefined plan. Very important. Now, what are the main emotions of traders? There are many, but here's just a few. First of all is greed. It says, man, I'm sure the market will rise, so and I'll make millions. Then you get fear. It's a way of, please, I don't want to experience another loss. And then panic. Oh no, the market is moving fast. Or why? What should I do? The sky is falling. Must I go in? Must I buy now? Must I sell? You know, that type of thing. The moment you see the market moves, there's panic. And panic says to me, there's no plan. Another one is indecision. Should I enter this trade or should I wait? Okay, now I'm in the trade. Should I take profits? Or you see what I'm trying to get at. And then excitement, hopefully, hey, I made some money. Now the question is, how many negative emotions are on this list? And that it's just too many. In order to become a successful trader, you have to have control over your emotions. The best strategies and tools are useless if your emotions take the upper hand. Now, to have a plan for the trade will take control over the emotions. Right, and then the next step is, it is treated as a business. Now, who is this partner? Who is your partner in this business? Is it your wife? Is it your husband? You got to have a partner. You cannot sit there trade alone, because then that's a one-man show. It should be treated as a business. So the feelings and emotions of the people in your house surrounding you must also have an influence in your business. They also got a say. And then point number 2, do you have a mentor? Do you have someone that you can talk to about these emotions? You need someone. If you really want to talk to me, you're welcome. Send me an email and we can talk. I won't say I will be able to help you, but at least just to talk to someone might just help you. Right, then point number M says, they spend some profit. Reward yourself and your house from the profit. That's being successful. It's when you start using from the profit, and by that I don't mean taking all your profit and there you go and you come back and you're broke, but spending, reward yourself and your family. And then another thing is, point number N is their overheads are under control. Don't let your overheads, spending too much on books and this strategy and that expert advisor and things like that. Have your overheads under control. You should come to a point where your business have about sort of fixed overheads, except for a sort of capital expenditure, where you say, righto, here's a guy that's got a nice course, I want to buy it, and then you buy it. But that is not overheads, that is capital expenditure at the end of the day. And then the last one I want to talk about is, they have become disciplined. Now, never relax a stop loss. You put it there in the first place because that is what your plan said, that's where support is, or that is where the resistance are. And then you can take a stop loss closer to the action after some analysis. Now sometimes if there's news that might influence a trade and I'm already profitable in this trade, what I will do is I will take my stop loss closer to the action to secure a little bit more profit pips. And if the news does influence the trade and my stop loss is triggered, at least I anticipated it and I move it closer. When you're in a good trade and it starts running and you can see there's a momentum change, you can higher or lower your stop loss to get closer to the action, so that when the momentum does change, that you still put some money in your pocket. Right, that's it. There's a lot more that I can say, but this is what I wanted to say about the two reasons for, the first one is reasons for not being successful, and the other one is reasons for being successful. Right. Hope you've enjoyed this, and next weekend I will do our first one, and that is going to be getting started. That's what I'm going to talk about then, at that specific one.